Many entrepreneurs build a successful business but still struggle financially because they don't understand the story that their numbers are telling them. Most business owners focus on sales, revenue growth, and bank balance. But wealthy entrepreneurs understand profitability, financial position, and cash flow. Today, we're going to break down the income statement, which is, are you profitable? The balance sheet, what is your business worth? And then your cash flow statement, where is your money going? And then we'll talk about why profit does not equal cash. So, there's three different financial statements, and those financial statements tell three different stories. Your financial statements, think of them as a dashboard in your vehicle. You would not drive your car by only looking at the gas gauge. Your business needs multiple indicators, and that's what your financial statements are there for. The income statement answers, did my business make money? Your balance sheet answers, what does my business own and owe? The cash flow statement answers, where did my money actually go? Let's start with the statement that most business owners know the best, which is your income statement. That's your profit and loss statement. Your business can make $100,000 a year and still lose money. The income statement shows your business performance over a period of time. Think, how did we perform this month, this quarter, this year? This is where the profit and loss or your income statement really comes in. So it shows your revenue, your cost of goods sold, gross profit, you back out all of your expenses and get down to your net profit. So you start with revenue. That is money that you've earned from selling products or your services. It's your bread and butter. How do you generate cash? It can be consulting fees, product sales, memberships, service revenue. Some questions you should ask about your revenue. So as you're looking at this financial statement, what should you be asking? Is your revenue growing? Which services are the most profitable? And are you too dependent on one customer? Depending on the answers to those questions are things you will need to work through on your own with your team. You want revenue to continue to grow, especially as inflation continues to grow. You need to at least be able to keep pace with that. As far as which services are the most profitable, then you'll start to come down on, do you need to shut down a line of your services? Do you need to ramp up other lines of services? And if you are too dependent on one customer, you need to do everything you can to try to fix that now. Maybe everything is great with that customer and you think you're going to keep them forever, but the odds are in this environment, in this economy, things can change fast. So if you are not prepared with what to do if that customer walks away, if that customer goes bankrupt, if that customer changes their mind, whatever it might be, you need to have a backup plan. And you need to be implementing that plan today while things still look good. The next section of your profit and loss statement is going to be that cost of goods sold. So these are costs tied directly to delivering your product or service. So some examples here, if you have a service business, those would be your contractors, direct labor, software required to deliver your service to your customers. Product, if you've got products that you're selling, this can be your materials, your inventory, shipping. When you take revenue minus cost of goods sold, you get your gross profit. So gross profit tells you whether your business model works before you take out your overhead. So before you pay the founders and before you pay management, before you pay for a software system that's not directly tied to delivering your product or service, you know if you're somewhat profitable and can afford all of the overhead that you have. So once you find your gross profit, which should be a positive number, you then move into your operating expenses. So these are expenses that are required to run your business. That can be everything from rent, marketing, insurance, accounting costs, payroll, software, and the list can just keep growing from there. Once you have that gross profit, you minus those operating expenses, you come to your net income, which is your profit at the end. And a lesson here, so some profitability questions you can ask as you're looking at this statement. Are your margins improving? Are your expenses growing faster than revenue? And are we pricing correctly? If your margins are not getting better, you need to evaluate how to make them better. So there's really only two ways to make more money in a business or in life in general, and that is to increase your income and decrease your expenses. You can choose to do both at the same time. You can choose to do one or the other. Doing one or the other or both are going to improve your margins. They should. And if your expenses are growing faster than your revenue, you will burn up whatever cash you have very fast. So you need to have a plan with what to do when you get to the point where you don't have cash anymore to operate. And then if you're not pricing correctly, then you are A, leaving money on the table that could be in your pocket, and B, you are running the risk of your expenses growing significantly faster than what your revenue is if you're not pricing things correctly. Revenue does not make you wealthy, profit does. $1 million in sales with really poor margins can still fail. There are large businesses and organizations that bring in a ton of money that still go under every single year. A smaller business with strong margins can build wealth. Wealth not only for the founder, but wealth for any other owners and maybe even some of the employees. This is talking through your profit and loss statement, your income statement. I am currently reading a book that is different, turns this on its head a little bit. So your income statement is you take all of your money coming in minus all of your expenses, and that is the profit that you as an owner, as an entrepreneur, a founder, get to keep. But the book I'm reading is called Profit First, and it is all about coming up with percentages. So if your revenue is $1,000 top line, that's all you bring in every month is $1,000, and you want to pay yourself $900 of that, then you know that that's 90%, and some of that money has to go to taxes, and some of that money has to go to other expenses. So $1,000 is not a great dollar amount for this example. 90% is not ideal. So I highly recommend the book. I'm almost done with it. Once I get through with it, I'd love to do a review here on YouTube to talk through what that looks like. So what he explains in the book, you take where you are right now. So let's say you're paying yourself almost nothing, your expenses are really high, you're not really saving for taxes. Take where your percentages are today. Take your ideal numbers you want to get to, and he does have percentages broke out in the book with where you should be headed. And then you slowly, every quarter, add a percentage to the areas that need you to add a percentage. Usually, most people don't have profit at year end, and they aren't paying themselves enough, and they're not saving enough for taxes. So normally you're adding a percent to those three, and then you're reducing, it's normally in operating expenses, because you can cut small increments from there over time as needed. So that is one thing I just wanted to highlight here, that the income statement shows profit at the very bottom. And a lot of times business owners will see profit and say, well, where'd all that money go? Especially when something like your tax bill comes around once a year, and that tax bill is $20,000, but you had $30,000 in profit. So surely you've got an extra $20,000, $30,000 sitting in your bank account. But usually by that point, when your taxes are done and filed, it's April or May, it's too late. That money's already been spent somewhere else. So no, it's not sitting in the savings account. But using a system like Profit First, you are putting money for profit and for your salary and for taxes into a savings account. So at year end, when you get a tax bill, it's there. You know it's there, and you can pay it. So just something to think about. I will share more of that as we go. This was more walking through what does a profit and loss statement even look like? What does it mean? What are some questions you can ask yourself? So the balance sheet, we're going to talk through next. Your income statement tells you how you performed. Your balance sheet tells you what you actually own. So the balance sheet is a snapshot of your business on one specific day. So your profit and loss statement we covered before covers a period in time. So you can run it for a day, a week, a month, a quarter, a year, but your balance sheet is only going to show you at that ending date what were your balances. And so what does that look like? So what that looks like is the top part of your balance sheet is always going to be your assets. So your assets here, so you've got assets equal liabilities plus equity. And assets are the things that your business owns. That is your cash, your accounts receivable, so the customers that are supposed to pay you money that maybe haven't paid you money yet, your inventory, your equipment, investments, all of that sits in the asset question. So one of the questions that you can ask yourself is, are we collecting money from customers? Is that converting to cash? Is your accounts receivable converting to cash? Are assets growing? And are we investing wisely to protect those assets that you have? Your liability, money that your business owes to someone else. Examples can be loans, whether that's a mortgage, a car loan, a loan on a piece of equipment, credit cards, account, or that is money that you owe to somebody else. So maybe you got a bill in the mail from a vendor, but it's not due for 3 months. You want to put it on your books and accounts payable until you go ahead to actually make that payment. And payroll liabilities is another liability you can have. So some questions you can ask here is, are we taking on too much debt? What if it gets called and you need to pay that off? Do you have the assets to pay off those liabilities? Can we meet the obligations that you've assigned to yourself? A lot of banks do look at what assets you have, how much revenue you generate, but if you are not going through a traditional bank for a loan and you're doing seller financing on things or your credit cards, they may not look as closely and they may just give you blindly a check almost that you will not be able to repay one day. So your equity is the last section. So it's assets. So equity is your owner's financial interest in the company. So to figure out what that looks like, it is assets minus liabilities equal your equity. A profitable company can be financially unhealthy if their debt is too high, they have too much cash tied up in receivables, and if inventory is excessive. So if you have a large amount in inventory that you cannot move, that is not a good thing. You want to be able to have the cash to do things like pay your rent, to pay payroll, whatever expenses you may have. So your business can be profitable, but broke. So what that would look like is when you're profitable but broke, you can show a profit on that first statement, that profit and loss statement, $30,000, and then you come over to your actual balance sheet and you don't have any money in your bank account. So I'll give you an example here. Let's say you sell $50,000 this month worth of product. Your customer owes you $40,000. That's okay. You book that as an accounts receivable. They've got 60 or 90 days to pay that. So you get to record the profit for that $50,000 you spent, or you sold. You sold 50, cost you 10, but the client owes you 40. They only paid you 10. So that 10K in cash you got from the client today goes to pay your expenses and you have nothing going into next month. If an emergency happens, if anything happens, you've got no extra cash because it's all tied up in accounts receivable. Another example I wanted to highlight here, so just to walk through like a transaction, let's say an owner invests in their business, that cash converts into an asset, and then the 10 cash also goes into owner's equity, just to kind of walk you through what that looks like. So if you buy a piece of property, that is an asset, but if there's a liability attached to it, like a mortgage, you record $200,000 of an asset for the land, and you'd record a liability of $200,000 as well. So they always equal because it's assets equals liabilities plus equity. Just want to highlight that one more time before I move on to the next statement here. So the next statement is your cash flow statement. Cash flow is the heartbeat of your business. So cash flow answers, this statement answers, why did my cash increase or decrease? And your cash flow is the heartbeat of your business because without cash, as I highlighted in the example where you sold $50,000, but your client only paid you $10,000 at the moment, and you had to use that $10,000 as an expense, you don't have enough cash flow to cover the next month of payroll until that client pays. So even though you're profitable without that cash, it limits the things you can do. Usually businesses that find themselves in a situation like that, the owner winds up investing more into the business to make ends meet. They take out lines of credit all over the place and credit cards just to make payroll meet, to make ends meet across the board. And it's a vicious cycle to dig yourself out of that. So for the statement of cash flows, there are 3 different sections. You have an operating activity section, an investing activity section, and a financing activity section. So operating, the first section, is cash from your normal business operations. That can be customers paying you, you're paying your bills to your vendors, can be payroll, that's all operating. For investing activities, that is buying or selling long-term assets. Maybe you needed a piece of equipment, a vehicle, some type of investment to put extra cash in, whatever it might be, that's an investing activity. And then a financing activity is money from lenders or owners. So loans, owner contributions, loan repayments, those all fall under financing activities. Growing businesses often fail because growth requires cash. You may need cash to hire your next employee, to purchase more inventory to grow the business, to market, to let potential customers know that you're doing business, to buy equipment to scale up your operation. You need that cash, and usually you need it before the revenue gets there. So normally you need inventory to make those sales. You need to pay money to market potentially so people know you exist. And that's the hard part of being an entrepreneur, is how do you balance that need for cash with getting by, bringing in enough revenue to get by. Growth can actually kill your business. A company can grow too fast because the expenses are happening today. Expenses happen right now, and the cash doesn't kick in until later. So if you are not carefully planning and tracking what it is that you're doing and how fast you're growing, your business will fail. If you want to triple your business by the end of the year, so you go ahead at the beginning of the year and hire triple the staff, but you can't find enough customers to justify that and pay the payroll for that, you're going to have to let people go. And if you keep them too long before the revenue kicks in, you will run out of cash and be forced into bankruptcy before the customers even find you and your amazing product or service. So profit does not equal cash. This is one of the most important financial lessons that an entrepreneur can learn. Profit is an accounting measurement, but cash is the money that you actually have available right now. to pay your bills, to do business, to make ends meet. So I have some scenarios that I'm going to walk us through here. So scenario one, you've got sales growth. You sell $100,000. Customer pays you in 90 days the full $100,000. Your bank account shows the profit the day you sell it, but your bank account, so your books show the profit the day you sell it, but your bank account doesn't show profit until 90 days later. So you've got a 90-day runway to finish providing those services or products to that client, and you won't get paid for it until 90 days after. Scenario two here, debt payments. So you purchase a piece of equipment. You decide not to expense it immediately. Maybe you decide to depreciate it over time. So that smooths it out on your books. So when you record depreciation, it's recording like smaller chunks of a payment. But when you purchase that equipment up front, your cash leaves immediately. It doesn't care how long it takes to recoup that from somebody, from a customer. It's just gone when you make that purchase. Another scenario I have here are loan proceeds. So you receive a $100,000 loan, which is great. You can pay some bills with that, so your cash goes up, but you don't make a profit from that. There is no profit to show for your cash increasing. So that's another thing as well. The biggest financial mistake entrepreneurs make is confusing profit with cash. So how do wealthy entrepreneurs use their financial statements? They shift from just understanding the financial statements to actually applying things in their financial statements to make better decisions. To me, that's what accounting is all about. Sure, it's historical. We are looking back a month, 2 months, a quarter, a year, and looking at where were we then, where are we now. Great. But it's what you do with that information. It's how you decide to shift and change and grow from there. Once you have that data point, how do you go forward? How do you move forward and make it better and do something different? So I'm going to talk through some monthly questions that entrepreneurs should ask when they're looking at their financial statements. Income statement. Are we profitable? What does that bottom line say on your income statement? Which services make the most money? Maybe you need to lean into that more. Market that up more, scale that up more, whatever you need to do. And are your margins improving? Are they getting better over time? Your balance sheet, you should be looking at, are we building wealth? Are our assets continuing to grow while liabilities are decreasing, so our equity is growing? Is the debt that you carry manageable? If it was called today, could you pay it off or pay a large piece of it? Are the consumers actually paying you, or is it just sitting in accounts receivable? For your statement of cash flow, do you have enough cash to operate, to function, to make ends meet? Can you afford to grow right now? Do you have the cash for that growth? And are you planning ahead with what cash you do have? The financial statements, 3 financial statements, they tell 3 different stories. The income statement is, did we make money? The balance sheet is, are we building wealth? And the cash flow is, can we survive and grow? If you're building a business, understanding your financial statements is one of the most powerful skills you can develop. So here, I will have weekly lessons on financial confidence and create long-term wealth. And that's going to be 2 different pieces. So before I go too far into that, I do want to pause and say your financial statements, you should be looking at them. You should be looking at them every single month if you can. And it doesn't have to be a deep dive where you're clicking on every single number and every single statement and trying to find to the penny why there's a difference. Your accountant should be doing some of that. And they should be helping you and guiding you, but you at least need to be aware of where you are on a monthly basis and ask the right questions. Ask some of these questions that I've highlighted in this video. Ask them. just because your accountant, you love them and you trust them and they are doing a great job, maybe they've done a great job for 12 years now for you, that does not mean they know everything. That does not mean you can't ask them a question, because you should ask them questions and they should welcome questions. And if they get defensive, that is not the person for you to be running your books, and you need to find someone better. So that's my little rant on asking good questions, reading your financial statements. Have the person who is preparing them for you help you. Look at them and read them if you've never done it before. Have them give you some highlights, but do your own research and come up with your own highlights as well. So that brings me to more education. So I love sharing things here on YouTube. I love teaching one-on-one or larger scale groups. Love teaching, but I also am going to start doing monthly webinars. So I've got a monthly webinar series. It's the third Wednesday of each month. So in September, it's September 16th from 5:30 to 6:30 p.m. Eastern Standard Time. It is on my website. You can sign up for free. They are free webinars. And on September 16th, we're going to cover the numbers that every business owner should track. So I think that that's going to be a very helpful thing for each and every one of you to be there, show up, get the free resources, ask your questions. It is a live webinar, and I very much welcome questions. Now, I may not be able to, on the webinar, have you do a screen share and we go deep dive into your personal business, but I will be more than happy to answer any questions you may have. And if we need to connect after that, we can do that too. So thank you for tuning in today. Stay tuned for some more videos in the future, and I look forward to seeing you at future webinars.